Michael, we have the rand trading back in the mid-720s against the dollar, also looking pretty good against the crosses at this stage. And this is despite risk aversion in this market. Yesterday trading around 730, above 730, so looking pretty good again for the rand.
Yeah, Stephen, look, I think it predominantly is a function of a weaker dollar environment. We've seen, of course, as the dollar has weakened, commodity prices have kicked a bit higher, and that's benefited the rand, obviously a commodity-orientated currency, and obviously it's conducive to inflows into our resource-laden stock market. So I think it's really a function of a dollar play more than anything else. I think the world out there is still very concerned about the global economic recovery, and as a result, we've seen some disappointing figures coming out of the States. The dollar is coming under pressure. We actually have revised our currency forecasts. We now believe the rand will end the year around 770 to the dollar, around 950 to the euro, around 1160 to the pound. That's a slightly more bullish rand view than what we had in the previous month. Not marginally, we were calling for 798 rand to the dollar by the year end, but we just feel that the rand could possibly sustain its gains for a little bit longer. Still weakened from current levels. I still think 720 is going to be a hard nut to crack to the downside for the rand bulls, but we do think that the rand will probably not weaken as quickly as we believed, as I say, last month.
Why have you changed your forecast, Michael? Is it because of those inflows we're seeing coming into South Africa? Do you think they're going to continue to support the rand?
Well, Stephen, that's the million-dollar question. I think we've obviously seen pretty light volumes over the Northern Hemisphere summer period. I think people will be coming back from their holidays in earnest from September onwards, and we're going to see if this trend continues. But I think the smart money suggests it probably will. There's been a global demand for bonds. Equities have fallen out of favour, and given that South Africa is offering a relatively attractive yield, the currency is strong, and you might even earn some capital appreciation on your bond if the Reserve Bank cuts interest rates. I think South Africa is offering some pretty good value for those bond investors out there, and that is indeed one of the key reasons why we think this rand could sustain its gains for a little bit longer.
Well, looking at some of the risks perhaps for the rand, we have strike activity continuing. In fact, the auto sector, apparently 2,100 units a day not being built due to the strike, and that must be affecting exports of motor vehicles from South Africa at this stage, which will put pressure on the trade balance.
No doubt about that, Stephen. I think it's definitely a negative for the rand. I think other domestic factors are also negative for the rand, the mining rights issue. These kind of things are definitely not rand positive, but it just seems to be having been overlooked by the investor community. Everyone's just picking up yield, buying bonds, and I would agree with you that these domestic factors don't bode well for growth. They don't bode well for domestic inflation, but as I say, they really just aren't in the focus at this stage.
Well, just taking a look ahead at some data coming out in the near future, we have our June retail sales tomorrow, and I see consensus is for a 5% increase. That's from 4.6% in May. And of course, the World Cup must have had some effect in these numbers.
You would think so. We obviously saw quite a lot of spending coming through during the World Cup, and we would expect the retail sales to be buoyed by that, as well as some low base effects of 2009. Of course, the critical question is whether this can be sustained into the third quarter, especially at a time when unemployment is kicking higher. We are a little bit skeptical that consumption expenditure is going to be robust. But having said that, if we're seeing these high wages coming through and real wages are increasing because the wage increases are outpacing the inflation rate, then perhaps the consumer could actually defy expectations and prove to be a little bit more robust than what we were anticipating. So just coming back to your earlier point, I think a lot rests on how these wages actually pan out and whether or not we will see a sustainable improvement in retail sales going forward.